Okay. Welcome, everybody. This is scary. You know me, live stream, technical difficulties. All right, we're good to go. Wow, I got it right this time. I noticed somebody already made a comment. Looks like it's the right live stream. Yeah, that's referring to the fact that the last time I tried to do this multi-streaming stuff, it sent everybody to the wrong place. So I think I've got it figured out. My comments haven't showed up yet, but maybe those will kick in a second. I've got this new software where it's actually internal now. So hopefully, if everything works, and I'm not going to test it live, I'm just going to kind of hope for the best. But I think we're out to Facebook and LinkedIn as well. So YouTube being the most important, I think that's where most people follow me from. But it is kind of cool to fire this off to Facebook and LinkedIn. Have a few people over there that maybe they want to watch it on that live stream. So I think we're good to go. Wow, that's exciting stuff. So from here on out, yeah, I'll do that. This is what I mean. So another cool thing I've been told, and this is the first time I get to actually see it, you can see the YouTube icon next to Nick's comment there. I believe if you're on Facebook or if you're on LinkedIn and you ask me a question, I believe it's going to have, on Twitter, it'll probably be the little bird, and LinkedIn, I'll be able to see if people are asking questions from different platforms. So very, very cool. Got some questions coming in. I will leave plenty of time today, of course, for the Q&A. Everybody loves the Q&A section. I'll leave a good amount of time. But the reason that we're doing a live stream today on the Iron Condor strategy is that our Iron Condors course that I'm putting together for the VTS community has launched officially this week. We did our first video. Just kind of remind people, just in case you didn't catch that, you've got the... if you go to the YouTube channel, let's do a screen share here. Let's get rid of that comment. What's going on? Oh, everything looks new. This is a beta version of the software. So several times today I might go, oh, wow, what's going on? This is new. But essentially, this is what you're looking for. So this video right here that says Iron Condor strategy, it's live now. And that's actually part one of the VTS course that we're putting together. This will eventually be quite a comprehensive course. It's going to be, at this point, it's going to be 30 individual lessons. And every time I think of something, I'll add more to this. But we are live and we have started, so exciting stuff. Yeah, this all looks new to me, so I'm going to be stumbling around today. But anyway, thank you so much, everybody, for joining me. This is going to be a tutorial covering the basics of the Iron Condor, basically covering some of the things that I went through in that video. That video was only about 10 minutes long, and I've already had several follow-up questions, so I'm going to kind of touch on a few things that people are asking about. I've got something else flashing at me here. I hate when things like little red flashing lights are usually not a good sign. So before we get started, I would very much appreciate everybody just giving the video a like for me. Just take 10 seconds to do that, please. YouTube algorithm loves those likes for some reason. I think the ratio of how many people watch your video or your live stream compared to how many likes you get, if you can get that up to 10 or 15%, it's pretty good for the algorithm. So everybody, give it a like for me. And yeah, let's just dive right into this. So going to do a little bit of a presentation. This is, as always, if you've been to my live streams before, you know that this is mostly for me, just to keep my thoughts in order. And so I'm not gonna do this on on a presentation view, because I like my little pointer. So hopefully everybody can see that. In my software, I tried to make it as big as I could. But we're going to talk about the Iron Condors. So first of all, why would we even trade an Iron Condor? I think that's quite an important question to answer, first of all. So this is the S&P 500. This is today. You can see we're down about 0.3%. Markets are up quite a bit lately. But essentially, the reason that we open Iron Condors is partially one of the reasons why we open any trade. If you look going forward, this is the S&P 500 today, and each one of these red hash lines is an options expiration. But going forward, of course, while there are some people out there that will claim that they know exactly what's going to happen next, and they'd be more than happy to tell you on Twitter that they have clairvoyance on that. The truth is, none of us really know what's going to happen going forward. I could certainly imagine that just given we just had a good jobs report, whether it's good or not, I don't know, but it sounded like a pretty good report. It beat expectations. Given the fact that inflation, there's a few hints out there that it might start to cool off a little bit. The Fed definitely gave some language that might hint towards their slowing of their interest rate hikes. I don't think they're going to stop it quite yet, but they might not be doing the full 0.75s going forward. So I could certainly see the market continuing upwards. But at the same time, it's done really well lately. It would not be surprising at all if it had a pullback. And there is enough negative news out there that we could definitely see the market right back down to here. I mean, maybe not the absolute low where it touched, but somewhere in this range, sure. So if you're in a situation where it could go up, could go down, in our heads from this point going forward, you just want to click in and say, oh, Iron Condor, of course, right? Why would we do an Iron Condor if we don't know where the market's going forward? Well, most people, and I would imagine this is somewhat universal, but probably 95% of investors out there, give or take, are in some capacity net long equities, right? That's typically the case where most of the world, most of the time, wants the stock market to go up. So if it does continue upwards, most people are going to be happy with that, and they're going to make plenty of profit. Myself included. I've got the majority of my portfolio will do just fine if the markets go up. A lot of people out there, hopefully, actually I shouldn't say a lot, very few, but hopefully you're a savvy investor and you have something in mind to do if the stock market collapses, right? You're not just going to sit there and watch it go down. You've got some mechanisms to get into safety and all those things. But very few people have anything in their portfolio that will make any money if the market doesn't do a whole lot of either of those things. And to be honest, that's actually a pretty common thing in the market. I know we're used lately in the last couple of years to see very strong uptrends and then very quick crashes, but the market does actually spend a significant amount of time just chopping around sideways. So that's kind of where the Iron Condor comes in. This is my portfolio, and I'll just go over this really quickly. Currently, right now, we have 5 equal weighted strategies, 20% each. And like I said, I have stuff that will do well if the market goes up as well. Defensive rotation, strategic tail risk, and tactical balanced. They will all do well if the market continues higher. This is a short volatility strategy, so it would also do well. It's just the high side is hedged, so there's no losses if we see a volatility spike. So it's also not super strong geared towards up markets either. But this will do fine as well. It's really this 20% of the portfolio that we're talking about. And this piece of the portfolio is what very few people actually have. No problem being net long equities. People love buying the stock market. But what do you do if 6 months from now the stock market's in the exact same place it is now? Well, that's what the Iron Condor is. So this is the basic shape of the Iron Condor. I'll get into it in a second, why it looks like this, how we build it. But you can kind of get an idea for why it's even called an Iron Condor, because I suppose if you look at it, it kind of looks like a bird. Hence the first person who ever came up with this thing probably thought, oh, wow, those wide wings look like a bird. So there you go, Iron Condor. But it is constructed by simultaneously, this is all done in a single transaction. Usually when people see this for the first time and they're not really used to option trading, they get freaked out right away. Like, how do I even keep up with all of this? It's all done in a single transaction, so don't worry about that. But it's a short put and short call option, and then a long put and long call option, all at the same time. And that creates this shape of the Iron Condor. So if you're not familiar with what any of those individual things mean yet, that's totally fine. This is an introductory tutorial. But what you will want to do is you will want to go to my YouTube channel. And in this little magnifying glass, you can search out things. Each of those 4 options that we're currently using, I already have videos on the YouTube channel explaining them. So this is the long call. You can put long put if you like. But we've got puts, verticals, long put, all of them. We've got the shorts. All 4 of those are covered, plus many more. So you can go on the YouTube channel and you can get the full tutorial there. But essentially, this is what it is. And again, you can check out the individual ones. If it's all done at the exact same time in one single transaction, it creates this shape of a trade. And the reason this shape of a trade is what we're looking for, here's the stock price right in the center. And typically we open these with the stock or the ETF or the underlying index. very close to the center of this condor. So right in the bird's face right there. This is where the stock price is. So if it goes up really strongly, of course, this trade could lose money. If it goes down really strongly, the trade could lose money. But you can see what we're actually trying to have happen here is that it stays in that center range. And this is why it is a good strategy for adding diversification to a person's portfolio. Because like I said, people don't worry about the extremes as much as they have nothing covering the centers. And while I am a tactical investor, this is a recent email we sent out, you can see that my strategies are very similar to that, to be honest. I believe they're better because they cover both long and short. But you can see we will be in the NASDAQ index when the markets are going up, when volatility is stable. And then when the market starts to go down, we will move towards utilities and cash, right? So we've got both sides of that covered. You can never guarantee that you're going to make money, but it would mitigate the damages, of course. This other one, same thing, Dow Jones in good times, moving to cash and gold in bad times. No guarantees gold is going to do well in a crash, but obviously I would rather take my chances with cash and gold than I would the Dow Jones, which is obviously crashing in a market crash. And then the same thing with the strategic tail risk. Long equities, nothing wrong with being net long equities during stable markets, but we need to move towards things that are a little more stable, real estate, and then long volatility. So I also have a portfolio that is not concerned about the high or the low, but doesn't necessarily have a whole lot that's going to capture that middle range. So for me personally, and like I said, probably for 95% of you out there, having a sliver towards this type of strategy would definitely be a good idea. Because at that point, you know that you've got something in this middle range covered, plus you've got all those sides covered, hopefully. The up is easy, the down is actually very difficult, but I'm just going to trust that you've watched lots of my live streams in the past and you know how to deal with down markets as well. So that's essentially what the Iron Condor is. Now, after I released that video, I had a lot of follow-up questions about the Greeks specifically. So it is in that video. You can get a recap there. This chart is in there, but I want to actually attack those individually and kind of explain further what these all mean. Because they are important, not only for Iron Condors, but options trading in general, and just to understand market dynamics themselves. You will hear these terms being used even outside of options trading. So it is a good idea to understand what people are talking about, that they're not actually speaking Greek. These are the Greek symbols that we use for option trading. And the first one being delta. Delta measures the sensitivity of an option's value with respect to price. So the reason the Greeks are really cool is based on how they're moving around, we can actually see what our specific option trade will be doing. So it's a way that we can look at other aspects of the market, price, time, volatility, and we can have a very good idea of what's going to happen going forward. And delta is one of them that does that. So when you see delta, you just think price. Delta, price. And what it essentially is showing how the option's value will change given a $1 change in the underlying stock price. So I will get into an actual live example in a few minutes, but the underlying stock, if it moves $1 up or down, that's what delta is measuring. It's going to actually show how much my Iron Condor will make or lose, which is pretty cool. We can actually get a very good idea of risk management if we know these things. Theta measures the sensitivity of an option's value with respect to time. So again, when you see theta, you think time. And it's also a 1 unit measure, but this time it shows the option's value with a change given the passage of 1 day. So delta is a change of $1 in the underlying. Theta is the passage of 1 day in the underlying, of course. So we're always using 1 units here. Vega measures the sensitivity of an option's value with respect to volatility. And Vega is one that you will hear often said out there, even not talking about options trading. So good idea to understand kind of what it is. And it's a volatility measure. And again, the same thing, we're using 1 unit here. But Vega shows how an option's value will change given a 1% change in volatility. So delta is a $1 change in the underlying, showing what our option will do. Theta is the passage of 1 day and what our option will look like the next day. And volatility, Vega, what will happen if volatility goes up or down by 1%. So Now I'm actually going to go over a live trade and show you how to do all of this in your trading software. Now, you probably don't use Thinkorswim, or maybe you do, it's quite popular, but a lot of people use different softwares. So yours will look similar to this, but not exact. So you're gonna have to kind of do the best you can. But we sent out a live option trade. This was for August 2nd. So this went out on Tuesday. And I'm just gonna use this exact trade. So you can see one trade there. Based on all the volatility metrics, I think it's a good idea. Right now, it's a good environment to open an Iron Condor. So that's what we did. And when I send out information, I'm always pretty thorough about it. I'll show, what the trade is. So this is it, 59 days to expiration. Here's the picture. Here's what it looks like. Your software might not look exactly like this, but they're all sort of same functionality. So hopefully you get it done. Now, just a side note, I get an enormous amount of questions. Anytime somebody has trouble executing any one of these trades, which it can happen, right? People are unfamiliar with it. Almost always it is the mobile apps that are happening. So I can't speak on that. I don't trade using my phone, but just know that if you're having issues, your mobile app might actually look significantly different than this. But allocation size, 3%, I'll get into that in a second. And then calculating contracts, this is much easier than it looks, but of course I'm quite a thorough person, so I like to show everybody the calculation. And then risk management, super easy. We use 50-50, and I'll get into what that is. So when I'm trading Iron Condors, I will always use a spreadsheet first. I will always plan out my trade. So in this case, I would always mark it with blue when I'm doing my planning, like this. And I would actually go through and I would plan out what I'm gonna do with this Iron Condor, both in the software. So I'm gonna find my expiration. It says 56, it was 59 that day. But essentially the trade that we opened, the live trade, is this one. So before I open it, I will plan it out in the software and I will write it all into the spreadsheet. So August 2nd, SPY. The net liquidation value, this is gonna obviously be different for everybody. For me, this is just a factor of, I don't like to show my actual trading account. I've just decided, I don't like to talk about money, show money, brag about money. So I don't show my long-term portfolio, but I deposited some money into this Thinkorswim account so that in the live streams we could actually do some live trades. And I execute all of the VTS trades in this portfolio. So that's where that number is coming from. It is essentially just, if I find August 2nd, you can see that number right there. I input this, and this value is important with respect to sizing the trade because I'm using a 3% allocation. So the spreadsheet calculates it all for me. Price, expiration, days to expiration, the VIX. IV percentile, I can actually show you really quickly. If you're a Thinkorswim user, you just go to the simulated trades here and then go down to the bottom where it says today's option statistics, and you can get the current IV percentile. This is measuring the implied volatility of the S&P 500 over a 52-week look back. So right now we're in the 40th percentile, which means that 40% of the values in the last 52 weeks was below today and 60% were above. Essentially, we are mid volatility. And when I opened my trade, it was 48. Volatility barometer, this is an internal VTS thing. I use 15 deltas. That will also be a part of the course. So just take my word for it. 15 delta is good for now, but this course will cover a lot of why I chose the 15 delta. And then this part, like I said, based on the net liquidation value of your account, I like to use a 3% allocation size. So hopefully you can see that coming through here. 3%, which means you just take 3% of the net liquidation value of your account, and that's the maximum loss for the trade. So I would just adjust the contracts. This spreadsheet will be sent out to everybody probably Monday. I'm going to do that, and then Tuesday I'll put together a video explaining each one of these columns. I've already written it all in, so it's sort of self-explanatory, but I'll give you that. But for example, if I did 15 contracts, that's not enough. I'm actually looking for an allocation of 7,700. If I did 21, that's going to be a little too much. With options, you go to the nearest full, and you don't add a dash. 7680 is slightly below 77, so 20 contracts. That's where that 20 is coming from. That's why in the live trade, I opened 20. And then the rest of it is all calculated for me. Stop losses are all there, which I'll get into in a second. But this is the trade. So the reason, here's this trade right now. Here's the S&P 500. And this was open 3 days ago, so our trade is up a little bit already. And this trade is good, again, because if the market rages higher, S&P 500 goes really strongly upwards. I already have net long equities, and I'm sure everybody watching this probably does as well. Unless your portfolio is really an outlier, you probably do. I've got the Dow Jones, real estate, NASDAQ. These are positions that will do just fine. If it goes this way, this is where you need to be a tactical investor. I can't speak on what anybody else does, but for me personally, you can see NASDAQ in good times. I would be moving towards these, and I would expect a little bit of insulation. Might not just flatline, might lose a little bit, might make a little bit, but it's going to be much better than being in the NASDAQ, of course. And again, moving to cash and gold, moving to real estate and long vol. So not overly worried about either direction. This is a trade where I want it to stay inside this range to make money for this trade. That's essentially what it is. So the last thing I will do before I execute this and show people how to execute a trade, it's very quick and easy, but I will actually mark my stop losses on the trade. So if you're using your spreadsheet, it's all in here for you. You can see the stop loss is 1160 in this case. If you're calculating your stop loss, what I do, you don't have to use 50-50, but I think that's the best ratio. 50% of the premium that you bring in is your stop loss. So if you brought in 117, I believe I actually officially got 116. Yeah, so I got a little bit worse than when I sent out the daily email. It ticked down one. But if you're doing 117, just multiply by 1.5, that's your stop loss. When that premium hits $1.75, it's at $1.05 now, you're out of the trade. That's your stop. On the other side, your stop gain is 50% of the premium that you brought in, which in this case is 59 cents. So when this trade gets to 59, then that's the stop. But in my case, because I do use this spreadsheet, and the full community will as well, starting on Monday, $1,160 based on my 20 contracts and my open premium. Super easy. I can just, on this pink line, I can just mark 1160. And it's bouncing around. The market is open right now, of course. So I would just move this until it says 1160 on both sides. Now, every time I log into my software, you don't have to be glued to your computer, but every now and then you're going to glance at this. And as long as this hash line is inside the two lines, you're good and your trade stays open. You are hoping that you make your money before it breaches one of the two sides, essentially what the Iron Condor is. Now, I'm just going to head off one of the questions that I'm sure is in the comment section or going to show up very quickly. Somebody's going to ask, well, if the price is here, let me move that and add a line. If the price is here, why does the stop loss on the high side look so much closer than the stop loss on the low side, right? I would imagine that somebody's going to be wondering this, that why would you set up a trade that's so vulnerable to the high side but is miles away on the low side? Well, it's actually not the case. This is where you just need trading experience to know this. But remember, Iron Condors, hold on a second. Something is wrong here. I've got too many windows open, maybe. Okay, that was odd. Remember, Iron Condors are Vega negative, which means, you can see that here as well, Iron Condors, the position benefits from decreases in volatility. Well, if you ask yourself, and I should say that this is going to be a full lesson, right? It's probably in here somewhere already. Lesson 1.10, why do the stop losses look uneven? This is going to be a Vega lesson. So essentially, I'll just do a 30-second little Cliff Note version here. But remember, Iron Condors are Vega negative. So if you go to the Vega, it's down here. We're going to lose money if volatility goes up, and we're going to make money if volatility goes down. What happens if the S&P 500 goes up 5%? Is this still going to be my stop loss? Probably not, right? Volatility will decline in that case because the market is going up towards stability. So this stop loss, which is here today, will probably actually be closer to something outside of that because the Vega will benefit my trade and that stop will expand. On the flip side, if the market crashes, by the time it gets all the way down here, volatility is going to be significantly higher, right? We would assume. Not written in stone, but that's a good assumption. So this stop loss, Vega will hurt us in this case, and this stop loss might only be there in a practical trading sense. So actually, the stop losses are reasonably close on both sides of this trade. It's just when you initially look at it today, given that the VIX index is at 22 right now, the stop losses look fairly lopsided, but they're not. We have more room than it looks on the high side, and we have a little bit less room than it looks on the low side. This is all going to depend on which direction the market goes. So if it does nothing, this trade is going to be just fine, and it's going to make its money. But that's essentially what's happening. So now, sometimes people like to see trades executed, because sometimes people do have execution issues. So I'm just going to show you how I personally get the good fill prices. And I always say, you don't have to sit in front of your computer. You don't have to nickel and dime these trades. I'm going to do one contract just to keep this in line with my portfolio and keep the spreadsheet the same and all that. So I'm going to open one contract of this, the 445, 365 for the 30th of September. So in Thinkorswim, you go to the trade tab. Again, your software might be different, but you know, I've not seen all of them, so I don't really know. I would assume that it's just the same in all of them. So you're going to sell an Iron Condor. And like I said, it's all of them at once. This is not difficult to do. Once you do 2 or 3 of these, you're going to be just fine as well. It's a single transaction. You would do the same thing if you were buying a stock, just a regular ETF. You would do the same thing. You'd buy or sell, and you do this. So all you do with the Iron Condor is you adjust. I said 445, 450. And I have to make sure that I get this right because I don't want to be closing out one of them. So I will double and triple check this one in a second. 365, 360. Okay, once we get that in, looks like the premium's 105. So it's 10 cents worse than when I got it, at least. I just want to double check, 445, 365. Do not close out this one contract here. So the short 365, short 445. That's all good. So this is my trade. 105 isn't a great premium, but it's fine. It is what it is. So what I will do, you can see the natural is 102, which means if I put in 102, I would get it immediately. This is a 4-leg trade, so there's going to be a slightly wider bid-ask spread. The mid price is 106, which is what I kind of want to get. I always want to lean towards that mid price. So I'll put something in that I don't think I'm going to get. 105. I'm probably not going to get the mid. So you would just check everything to make sure it's all okay. 106, the mid right now? Maybe. So I would send that. It's going to go into working orders. You can see I'm trying to get 106 and the trade is 105-ish. So I'm not going to get this, but I would still wait 30 seconds. I call this the 30-second rule. Wait 30 seconds, see if you get it. If you don't, you just go in and you adjust it. So you adjust it by one minimum increment. In this case, for the SPY, you can trade pennies. So I would go to 105 and I would do the same thing again. And I'm just going to watch. Wait 30 seconds. If I didn't get it, which I just did, if I didn't get it, 30 seconds later, go down to 104. Do the same thing again, and you get it. Basically, I mean, there are times if the market's moving really fast against you, you're kind of chasing and you feel like you're just barely missing it. I've had trades that I need to do 3 or 4, but the vast majority of time it's 2, anywhere from 1 to 3. The first try, always try for a price slightly better than you think you're going to get, because you never know, it might tick the other way, and you get that. And I do get that sometimes, and you always feel like, you know, yes, I got 1 penny better than I was expecting. The 30-second rule. Executing trades, I know it's a stress point for a lot of people. They think like, you know, what if in 2 hours from now I could have got $1.10, you know, and then I'm going to look back tomorrow and think, well, 105, well, that's not very good. Yeah, but it could also go down to 99 cents, and then tomorrow you'd look back and say, well, thank God I opened it at that time. I got $1.05. Essentially, long-term, it's all going to work out. Law of large numbers, half the time you're going to get slightly worse, half the time you're going to get slightly better. Just have faith in the market gods and the mathematics of the law of large numbers that you don't have to sit here for an hour. Just get your trade done, try to do a penny or two better than you think you're going to get, and you're good to go. you'll definitely handle it, no problem. So that's it. That's the Iron Condor. Like I said, there is going to be quite an extensive course, 30 parts right now, based on the follow-up questions that I'm getting from people and the emails that I'm getting. Oh, there's a nice car outside. This is like a supercar row here. I'm sitting in Dubai right now, and every 5 minutes you hear Lamborghinis and Bugattis going by. Pretty cool. So anyway, it would be a very good time if you wanted to join the VTS community. Obviously, no pressure. My live streams are free. You can just follow along for free. But we have done the first course. So if you wanted to follow along in real time, you could do that. There's eventually going to be 30, and you would have future access. It's just going to be a course that's now sitting there, part of the community. So that will be, we've got 5 strategies right now. I've done quite a bit of work on the volatility trend, so people really understand our broken wing butterflies on the UVXY now. And now I'm going to be diving into the Iron Condors to make sure that there's a full, it says 20, but I keep thinking of new ones to add. So now it's going to be a 30-part course. If you did want to join, just go to my website, subscribe. You can either do the $89 monthly, or you can do the $849 for the whole year. It's a 20% discount. If you're going to give me 1 full year to go through the education, you can follow our live trades, you can do that as well. And then you'll have full access to the Iron Condor course as you go as well. So that didn't take too long. Iron Condors are way easier once you start actually trading them. Option trading, I understand, can be fairly intimidating, but trust me, the barrier to entry is steep. I mean, we're talking about Vega and Delta and Gamma and all these things, and a lot of people online are going to try to make it sound way more complicated than it actually is to try to put themselves on the pedestal, right? I'm the teacher, and I know what Vanna and Vama is, and you guys are, the plebs down there, you don't understand anything. Maybe pay me money and I'll teach you what all these things mean. But the truth is, you don't need math skills. You don't need to understand all the technical stuff. Once you get in there and start trading and you get your systems, you have a foundation in place, which I will give people, you're going to learn just as fast as anybody else. So one of the things that bothers me is how people speak about options. It really turns a lot of people off. But trust me, anybody from any background can learn this stuff. Very important, though, because like I said, your portfolio probably does have a weakness. And the weakness would be, what happens if the S&P 500 does nothing for 6 months? You'd probably want to make a little bit of money in that case. And the Iron Condor is a really great strategy to do that. You can do butterflies, calendars. There's many different ways to have delta neutral. But condors are great because they're Vega negative. And typically when the market's doing nothing like that, you want to lean on the side of short Vega. So I really like them. And hopefully you do too. And after the 30-part course, I think you'll really, really understand them. So let's dive into the questions. I'm just going to see if Facebook or LinkedIn. I don't see any. They all have the YouTube logo on them. So first question, Chris Moon, do I ever trade weekly Iron Condors? No, I don't. There's nothing saying you couldn't, but the reason that Iron Condors are such a good trade, in my opinion, and I know that I will have covered this, and let me just see, where is it? Something about wide wings, I'm sure. Why longer? Okay, lesson 14, why wider wing iron? Oh no, short dated. Why longer dated Iron Condors are better? There we go. I knew I had it somewhere. If I didn't have it, I would have added your question to this. But the reason that shorter dated contracts are more dangerous is because your delta, which is what we reviewed, is the directional bias of the trade. And there's another Greek that you don't really need to fully understand, but gamma, which is a higher order derivative of delta, which essentially means that the closer you get to expiration, the more sensitive that gamma is going to be, which means that if you get a price swing, your trade can move substantially. And so if you're trading weekly options, there's nothing inherently wrong with trading Iron Condors on a weekly. But if you are doing that, you have to understand that if the S&P 500 has one single bad day, your trade is going to move a lot. But you can see this trade, because it has 56 days to expiration, Let's say the S&P 500 does move 3% on me or 4% in a single day. My trade fundamentally is going to be the same trade. And unless I was already just knocking on the door of the stop losses on either side, I'm going to be able to leave my trade open in that case. But if you're trading weekly options, it's not going to look this wide. It's going to look quite narrow. It's going to, you can imagine it's going to look something like that. And one single day is going to be very, very sensitive. So for me personally, investing is a long-term process where you want to eliminate as many variables as possible. You want to get as much control as you can get over the markets, which we can't control everything. But one thing that we can do is we can lengthen the time of our option trades so that we are far less sensitive to one-day single moves in either direction. If you're trading weeklies, probably it means that you're just going to set them up knowing that quite a few of them are going to fail, and you're just going to try to balance the ratio of more wins than losses. Where in my case, I'm taking a much more holistic portfolio approach where I need that trade to give me exposure to that middle market for longer than a day or two. I'm trying to get that exposure for weeks at a time. So for me personally, you won't see me trading short-dated Iron Condors. It just doesn't make sense. There are a lot of trades that work far better short-dated. One of them in particular, our short volatility UVXY strategy. This is a live trade we have on now. This strategy works far better in shorter dated. So I typically do, anywhere from about 10 to 18 days to expiration. And butterflies work much better because as they approach expiration, they become much stronger. If you open it and maybe the next day you get a big volatility move, they're a little bit less sensitive in the beginning, more sensitive at the end. So I prefer, if you're going to do short-dated contracts, probably stick to butterflies would be my recommendation. They're kind of a similar trade, except just the sensitivity around different price movements is better. So I think you'll just have better success doing very long-dated Iron Condors, 45 to 75 days to expiration, and consider it a stable long-term trade, not a weekly cycle trade. That's not going to work out so well. Why did the Iron Condor on this? Sorry, this is a new beta version of my software, so it does appear like I've not resized these. Sorry about that. Hopefully now that I've done it once, let me see if I close it and reopen it. Oh, perfect. That was easy. All right, cool. Thank you, Ecamm, for helping out an old guy figure that out. So now, why did this Iron Condor trade on SPY not use monthly options? Is there enough liquidity? So I used the quarterly. If you'll notice, in Thinkorswim, it labels them pretty clearly. I'm sure yours does as well. Weeklies. The monthlies are the ones that are in white. So the September, October, December. UVXY is going to be different. SPY has a whole bunch of choices here. Obviously, SPY is a very active ETF. So the quarterlies are just fine. The monthlies is what we typically do, but the reason I didn't do the monthly this cycle was there wasn't quite enough days. I like 45 to 75, and when I opened the trade, this middle one was 59. This one was 80, which that's a little bit long for me. I would like to keep it, below 70. And then the previous monthly, the September, it had 45, which is really sort of on the minimum end there. So I chose the quarterly, which is fine. I typically won't use the weekly cycles on the SPY. So it really depends on the ETF you're using. Some of them have plenty of liquidity. The SPY, I shouldn't say there's no way. I don't know how much money you have, but if you're trying to push through $50 million Iron Condor on the SPY, you might have a penny or two slippage. I don't know, probably even not that. Liquidity is super, super high. Also for the course, I'll be sending out that spreadsheet, which has a watch list on it as well. The basic things we trade, SPY, the Qs, IWM. We can do gold, we can do the GLD, we can do TLT, IEF even. As long as there's reasonable liquidity, you got to remember that you're not putting 100% of your net worth into an Iron Condor. In my case, it's 3% of the portfolio. And then Iron Condors themselves, they don't take up that much capital to use. And if you do want to push a lot of volume through, then of course you can go to the SPX, which is a cash settled index, 10 times the notional value of the SPY, or you can widen the strike gap between them. So I did a $5 strike gap so I can include the most number of people with smaller accounts. But if you're trying to push through a massive volume, instead of a $5 strike gap, you could extend it to 25. And now the contract size goes way down. So there are always ways to get your trades efficiently. But with SPY, you don't even worry about it. There's tens of thousands of contracts available. Okay. IV on individual stocks. Typically, I don't always answer questions like this because I've not seen too many other trading softwares. My long-term portfolios at Interactive Brokers, and this live stream account is at Thinkorswim. So these are the only two I've seen. I've heard Tastyworks is quite good, but I've not seen Fidelity, Schwab, and all that stuff. But you can also just use the implied volatilities here. So this is Apple. Let's say I was doing this one, 77 days. You can see that the implied volatility of Apple here is 30, right? So you could check that as well. And I believe even, I don't that often trade individual stocks, but there's no reason why you couldn't use the IV percentile for Apple as well if you wanted to use that. So you can either use the percentile, which can be deceiving. You have to know what you're looking at. Remember, depending on how the market moved that year, it might be very instructive to see a 52-week look back, but it might actually not be that useful if it's been a really crazy market. Then, okay, percentiles start to matter a lot less, right? So you could also just get to know your underlying that you trade. The first time you do Apple and you look at this and it says 30% IV, you might not know what that is. But fill in your spreadsheet, trade 25 trades, and essentially the reason I gave 25 lines here is because in order to be a reasonably proficient Iron Condor trader, I'm going to want everybody to get their 25 trades in. So at the very end, I called it a final exam. There's no exam, like there's no pass-fail. It's just going to be a questionnaire and ask a few questions. But one of the points I will make is, make sure you've done quite a few of these. But at that point, you're going to start to know what these IVs mean. You're going to know that a 30 on Apple is where it is, and an S&P of 22 is, slightly elevated, and you're going to get to know all those things. So there's two places you can check it. The third place, of course, is if you're a VTS member, my volatility barometer is the best indicator. So always default to the barometer. It's just for a public live stream. If you're not in the VTS community, you don't have access to the volatility barometer, then you're going to default to the IV percentile or just the IV of the underlying, and just get used to knowing what those mean. All right. It's not resizing perfectly yet. Let's try that for some of these longer questions. And where should I put it? How about right there? Okay, when we open our long put calendar options during low volatility, will we use the same principles that these Iron Condors, like 50% stops, 15 delta? I feel like I won't do it justice answering your question on the fly in a live stream, but essentially, if you were to do a calendar using the spreadsheet, if it was time to do a calendar, you're just going to copy and paste your calendar, and then it's the same thing. You just go across the board, and I listed in these things, which I will get into. I'll do a full video talking about this. But of course, a calendar doesn't have a long call or a short call. So it's just going to have the NA already put in for you. It doesn't have delta because a calendar is at the money. If you do a SPY calendar, come on, typing. SPY calendar. Yeah, of course it doesn't have it. For a SPY, if you do the quarterlies, you could just go down to here and open up. You would buy a long calendar. And this is under the assumption that volatility is very low now, because calendars, referring back to the course here, why calendars beat Iron Condors in low volatility. Calendar fundamentals. Calendars use different stop losses and stop gains, combining Iron Condors and calendars into the same strategy. So I will have you covered, don't worry. But that's why I said today I won't really do it justice. But if you open a calendar here, you can see, of course, there is no delta. You're just doing an at the money. So that's why in your spreadsheet, the delta will have an NA. We always do puts on calendars. I will always do the put calendar, just preference, I suppose. You could do the call. It's mathematically identical, but I just always use the put side. And then as far as the trade allocation, it will be different. So the trade allocation for a calendar will be half that. I should actually include that. I think I did here, the rules of engagement. You can see if, I don't know if this will stay there when I hover, but you can see down towards the bottom there, the calendars and condors have different stops, and they also have different allocation sizing. So calendars are super sensitive to the size because it costs almost nothing to open them. So the problem there is if you wait for a 50% stop on a calendar, you know, that's you're going to lose significant amount of money. You could also make, of course, but I always look for the loss side of things. So calendars, I typically go a 25% stop, and they are smaller allocation as well. So a 1.5% allocation with a 25% stop is going to be the same market exposure as an Iron Condor with a 3% allocation and a 50% stop. You can see why I need 4 videos to go through all this. I always want to be totally thorough, and that was not very good, but that's generally the answer, that no, they're going to be different. Similar, they're both delta neutral, they're both, you know, covering the same area of the portfolio, they have the same purpose. It's just calendars, the way that I trade them, longer dated, never allowing them to get very close to expiration, they do act long vega, whereas an Iron Condor will act like a short vega trade. Now, calendars that are short dated, taken right close to expiration, you know, vega doesn't really apply at that point because the front end is going to decay much faster than the back end. But the way that we trade long dated calendars, they are long vega trades. So during low volatility, of course, you don't want to be short vega. Volatility is already low. It's probably not going to go down much further. You want to be a long vega trade, and that's when the calendar comes in. Okay, how do you decide how wide to keep this spread? All these questions are going to be answered in the 30-part course, but I understand that a lot of you are not going to be, you know, signing up to the community just because you saw a live stream. But I'm going to try to do a good job with that. So if you wanted to join the VTS community for like 3-4 months, you won't hurt my feelings if you unsubscribe 4 months from now. Just jump in, follow the Iron Condor course. As soon as it's finished, you're going to have all the videos, and then maybe you can duck out if you want to. Hopefully I can give you some more value beyond that, but you're not going to hurt my feelings if you subscribe for, you know, temporary. But how do I decide to keep the spreads? What is the probability of success do you aim for? Should Iron Condors be held till expiration? I could keep referring. Yep, you knocked out all 3 of them there. So let me do the super fast version. How do I decide to keep the wings? I do 15 deltas typically on both sides, which would mean, if you wanted to know, if you're looking for the SPY, ditch that calendar. The delta column is right here. Essentially what I'm looking for is I will find the 15 delta, and then I will go slightly outside it. So in this case, if I was opening an Iron Condor right now, it looks like I would open that 370. So on the put side, I would be doing the 370, and then I can do a $5 gap. And then over here on the left, this is the call side, and you can see the delta, this D. I'm looking for the 15 delta, and then the next available strike, which is either a 0 or a 5, right? I always like to trade the high volume strikes, so it looks like the 445. So on the high side, I would do 445. So that's the same strike. It's just that the other one, the put strike, is brought up a little bit. So 430. So this, 450. I knew something looked weird there. This is the Iron Condor that I would currently open if I was taking the trade brand new right now. And you can see it's trading at 115. The only reason that happened is because, of course, the price has moved a little bit since I opened it on Tuesday. So we brought up this 365 to the 370. So that's how I decide personally. There's nothing saying you have to use 15 delta. There are people who like to trade narrower Iron Condors, which would basically have higher profit, bigger losses or lower losses, and it would be a more even trade. I like to look at them like that because it's insulated over a very large range. So that's the first part. Second part, probability of success. Delta can also be used as a probability. So a 15 delta on both sides means there's a 70% chance of success, essentially. It doesn't mean that if you ran the simulation, it would happen. It just, in the moment, a snapshot in time, 70% chance of success, 30% chance of failure. Doesn't matter to me, though, because I use stops. This is one of the reasons a lot of people say, well, this is such a terrible trade. Look, you can only make $115. You can lose $386. Who would open that trade? You know, it's so lopsided. Well, I don't care. I'm using a 50% stop, 50% stop gain. So to me, it's a 50-50 trade. I'm only trying to get half of this premium, and I'm willing to lose half of that premium. So for me, this trade is really slow moving because I've widened the wings out. If you want to do a narrower one, if you want to go for 35 and 380, go for it. You know, you could even go worse than that. You could do 415. Let me get one that looks really even. 400. You could do something that looks like this if you wanted. I mean, it's an Iron Condor. You can do what you want. It's just that this is going to be a trade that moves faster. So if there's a big shock in price from today to Monday, this trade is going to either make a lot of money. If nothing happens, the theta is going to be powerful on this trade, more so than the other one. But the downside is also going to happen quickly as well. And I don't want that. This is a long-term portfolio. So for me personally, wide wings, always wide wing Iron Condors. And I think you had one more question. Should they hold be expiration? Well, I hold them as long as until the stop loss hits, which is not even close to expiration. It would be surprising if the trade was open with 30 days left. It's going to hit one of those two. It's either going to make 50% of the premium or it's going to lose 50%, and I'm going to be out. So I don't close it down in a time frame. I use stops, and that's it. Okay, toss question. When you put a limit order for a multi-leg option purchase, is it an all or nothing purchase, like you don't get part of the Iron Condor? Can I do that on Interactive Brokers? So when you do a limit order, let's say you're doing, I think I understand your question, but sometimes live your brain is scrambled and you totally, I can't even read the English in front of me sometimes. Sometimes people ask a question and I'm like, what is he answering? It's not even close. I think I understand. So let's say you're opening 10 contracts and you do a limit order, and you're trying to get a specific good price for you. It is certainly possible that you only get filled one contract or 5 or 7. The thing about options trading that sometimes beginner option traders think is that there's some other dude on the other side of your trade. Like it's you and I'm trying to get this Iron Condor, and there's another person trying to buy the same Iron Condor as me on the other side of the trade. Or I'm buying a long put option, I'm buying 10 of them, and there's another guy out there who's selling 10 of them. And so we're kind of transacting with each other. Options are not like that. It's just a massive pool of single options, and the computers just pair everything up. And so, yes, it is definitely possible that if you're doing a limit order, you don't get all your contracts filled. You only get them filled if that's how many are available. But there are times, like if you're trading, you saw me execute that trade and it goes here. There are times when you hear it click, you hear that bell and you think, okay, the trade's done. And then you look in your working orders, and in Thinkorswim, it'll say a bracket and it'll say how many contracts are still trying to get worked out. So I tried to open 1, but the day that I opened 20, if I only got 10 of them, and then the market moved, right? The market did something, and now the price I tried to get is no longer available. Yeah, it'll sit there with 10 contracts unfilled, and I'm going to have to keep going until I get all my contracts filled. That can definitely happen. You are not transacting with somebody mirroring your trade on the other side. It is open contracts. So as another random example that has nothing to do with your question, but if you have a trade open and you have a, whatever option that somebody else on the other side of it can exercise, and somebody in the world exercises their trade for some reason, the computers just match that up. And so you might get your option called away on you or something like that. If the computer matches up that person and you happen to be the person there, then I guess it can happen to you. So yeah, it's just imagine it's just a giant market of randomness, and the computer does the best they can, but there's no guarantee that if you're using limit orders, you will only get it if that price is available. You can get none, you can get partial, you can get mostly, but you're missing one or two, which is always annoying. You're like, should I chase it for that final one or wait? Yeah, it's all possible. How long have we been going? I'm trying to keep these shorter, actually. A lot of people say, and I can see in the analytics, people start tailing off towards the end. There's only 26 people here. It appears there's only 19 likes, so I don't know what you guys are doing, but hit that like button for me. We have to have at least as many likes as people sitting here. I've seen some live streams in the past with a few people who they'll literally say, I'm not talking anymore until the likes are at 10%, and they'll just chill out. They'll just sit there, drink their coffee, dead silence, and then you're like, okay, well, we all have to kind of proactively make this guy continue, so I'm not going to do that to you, but I will ask you to hit that like button. All right, so I will answer a few more here. I'll try to be a little bit selective of the ones that aren't going to be a full segment of the course. Why don't you move your strategy completely? Oh, this is okay. Why don't you move your strategy completely into options instead of buying DDM GLD? Just sell naked put on GLD. Well, you wouldn't do a naked put, but you could certainly do stock replacement. A naked put option on the GLD is not at all the same thing as a long position on the GLD. So if you were trying to simulate your portfolio using options, if I was trying to simulate, or actually I should use my email, which would be better. If I was trying to simulate this strategy using options, I could certainly do that. I could just buy long put options on QLD at the right ratio, so it's representing 100 shares of the underlying, and I could do that. And then if it's time to buy the XLU, you sell this one and you buy long call options on XLU. Sorry, did I say puts? I meant calls over there. Stock replacement. And then you're essentially simulating the exact same market exposure. But a short put option on GLD is going to behave completely differently, of course, than a long position on GLD. It's the same directional exposure, but the risk-reward ratio is completely skewed because, of course, a short put option, you can only make the premium that you sell. So it's not a very good trend-following strategy to just do a short put option. You're capping your gain at the premium you bring in. I would much prefer to do a risk reversal or a long put option for stock replacement. Why do I keep saying puts? I keep saying puts because we're used to volatility ETFs and stock replacement. Long calls. Yeah, and you just adjust the delta factor. I could do that, but why? I mean, the whole community is going to be confused by that, and it's going to turn my entire portfolio into an options portfolio. A lot of people are going to be freaked out by that, so there would be no benefit to doing it. Stock replacement maintains the same risk-reward ratio. That's why it's such a good strategy to know how to do. To, instead of buying 100 shares of the SPY, to know how to calculate the correct number of long SPY call options.